Hi, folks, and welcome to another edition of Money and Politics. And today we are going to be talking about investing with ETFs. An ETF is an exchange traded fund. That's what the ETF stands for. You don't have to remember that, but we do want you to remember some of the more important things that we will be talking about today. And as always, I want you to be reminded that I am not a financial advisor nor a registered investment broker. The discussion's here for educational purposes only. I'm going to be covering things that some people, if you've been investing for a while, are going to be going, well, duh, yeah, I know all that. So this is for all the people that don't know. And one of my favorite tools, and it's free, of course, is Yahoo Finance. This is the finance page. If someone says to buy something, one of the first things I do is I'll come here and I start with SPY. SPY is the symbol for the Standard & Poor's 500 index. If you go on Yahoo and you put the holding in, as I did, and you can come over here and you can see that on the right column we look at the top holdings, and the number one top holding is Apple Computer. So when you buy one share or more of the S&P 500, 6.6%, almost 6.7% of your money is going to Apple Computer. 5.3%, I'm going to round up a little bit, is Microsoft. Then you have Amazon. Then you have Facebook. Then you have Tesla. So when you buy the S&P 500, you're getting, it's a weighted average. So the 500 shares that constitute the value are not all equal, as you saw. What I do is I put in the S&P 500. I go to the chart. This is on the front page of the Yahoo. And up here in the upper right above the chart, upper right corner, you see full screen. So let's go to full screen. And that's going to give you a chart. And of course, it's full screen of whatever it is you put in there. So you see we got the S&P 500. Along the top row, right above the chart, you have 1 day, 5 days, a month, 3 months. Typically what I do is I click on the 5-year chart. So let me do that. And here's a 5-year chart. And you can see how the stock or the S&P 500 has performed over a period of time. You see right here this deep sell-off, and that was last year just about this time, because right at the end of January in 2020, we took a nosedive because of COVID. And then it started to come back, and so we are today up higher than we were before. So for those people who, number one, think that they don't know how to invest in an individual stock, you're not comfortable investing in an individual stock, but you want to be participating in the growth of the U.S. economy overall, this is one way to do it. And folks, you could just buy the S&P 500 and let it ride, and just you could stop there if you want. I mean, investing in the market could be that simple. You can make it more complex, and we like to do different things besides just the S&P 500. But that might be one place where you could just start and stop. I mean, and you would be automatically diversified. So that said, though, let's go to up in the upper left corner. Again, this is one of my favorite tools. Now, when you put just one stock in, before I do what I'm about to do here, when you put one stock in, if you go over and you see the price it shows in green here is $370. Once we do a comparison, and because there's three primary, actually there's more than three primary indexes, but for the purposes of what we're doing today, I'm going to compare to about three. So we have the S&P 500 and the NASDAQ 100, and then we got the Dow 30. And you can see when I hit the comparison, and again, let me just click here and we'll redo it, hit comparison, you see they automatically already give you those three choices. So once I put one of these in, what it'll show is not the price, but how each of those grew over a 5-year, if I'm doing a 5-year chart, how much they grew over 5 years on a percentage basis. So let's compare how the Dow 30 index, they always give me that light blue. I don't like that. I'm going to go to, let's do a gold. And let's see how the Dow 30 index compared. You can see, obviously, the similarity in the chart pattern. And again, when you buy the Dow 30 underperformed over the last 5 years. The Dow 30 was up 82%. The S&P 500, as of January 31, which is when we are recording this, over the previous 5 years was up 91%. Not bad. In fact, that's very good. And one thing, and then let's go ahead and I'll finish this. Let's see how the NASDAQ did. And we'll say the NASDAQ, I'm going to make it more of a bright red so we can see it easily. And boom, look at the NASDAQ 100. And of course, the tech stocks almost always, not quite always, but quite frequently, let's say that, outperform the general market. And you see that here because while the S&P 500 was up 91% over the last 5 years, the NASDAQ was up 183%. Okay? Pretty good. And again, you could automatically diversify if you want. You could buy the S&P 500 and the NASDAQ. The symbol for the NASDAQ is QQQ. Okay? The symbol for the Dow is DOW, and the symbol for the S&P 500 is SPY, SPY. Now, some places where you buy that, if you're buying through Vanguard, they're going to have a little bit different symbol for the S&P 500. That's okay. But just when you go, just so you know, those are the symbols. Now, that said, let me bring up, and again, we're talking, if you just tuned in, we're talking on investing with ETFs and how you get automatic diversification. If I put in some mutual funds, almost every mutual fund is going to underperform the S&P 500, and they're going to have higher fees. So I prefer investing with ETFs. Love using these charts, and I like to go by the 5 years. And why do I like to compare 5 years? Because as we see, anything can happen in 1 year. And we have the COVID year, and so you don't want to be comparing what's happening in the market to what happened in 2020. If you go over a longer period of time, you're going to see how different investments perform and whether they are good to have or not. When you buy an ETF, they trade immediately like a stock, which means you can put an order in to buy, let's say the S&P 500, it's $370 a share as we record this. You could put in an order to buy 1 share or 1,000 shares if you wish. And you could do that at 9 a.m. And if you want to get out of that, you could sell that at 5 minutes later, 10 minutes later, an hour later, and immediately the trade goes through, or in most cases immediately, depending upon what's happening on the market. But the point is, you don't have to wait for the end of the day. And when you buy a mutual fund, you buy it, but you cannot get out of it during the day. You have to wait until the market closes. Why does that matter? Well, let's say, as an example, maybe you need a new car. Maybe you want to put in a swimming pool and you want to take some money out of the mutual fund, let's say, that you bought. The problem is when you call up and you go, hey, broker Bill, I want you to sell 50 shares of my mutual fund because I need $20,000 to buy a good car for my kid to go off to college. Well, if some major disaster were to happen during the day and the market was to fall precipitously, when they sell your mutual fund at the end of the day, after the market closes, you may not be getting that $20,000 you you thought you were going to get based upon what the price was when the market opened at 9 a.m. or 8:30 rather, 8:30 Central Time. You're not going to get that $20,000. Maybe you only get 18,000. Maybe you only get 15,000, depending upon if there was a severe sell-off. Whereas if you had had your money in an ETF, when you wanted to sell that, you could have just put that order in, and in 99% of the cases, it would have gone through right away as compared to mutual funds. Mutual funds, they have to determine what the price is per share. It's called the net asset value, and they can't determine that until after the market closes. So that's number one. Another thing is that ETFs have lower fees. Mutual funds frequently have much higher fees, and they have some hidden fees. Some mutual funds are charging as much as 3%. But right down here, if you go to the corner of that graph, the lower corner, and then just go right over, the expense ratio is 0.09%. That is really low. So if you had $100,000 and in a mutual fund, and they're charging you 3%, that's $3,000. If you're doing 0.09, that would be about $90 by comparison. Lastly, you have no surprise gains. And there's a money manager. And the money manager, during the course of the year, might take some of the stocks out of that group of stocks that he has in the mutual fund. It could be 25 stocks, it could be 50 stocks. But they might say, hey, we made a lot of money, let's say, in our mutual fund on Facebook, and they sell that. And there's a gain. Well, if the mutual fund manager sells some stocks in the mutual fund for a gain, you're going to have, as an owner of that mutual fund, a capital gains tax. Now, it might be that, and this happened back, a bad surprise for people back in 2008, it might be that your total mutual fund goes down in value, and then to add injury to harm, you have to pay a capital gains tax on some gains. And you say, how can I have a gain? I invested $1,000 and it's now worth $800. And you have a capital gains tax because within that mutual fund, they sold some individual stocks for a gain, but the total value of the mutual fund went down in a drastic year. In the ETF, is your ETF going to go down? Yes, it could go down in value, but you're not going to have any taxable event, which is what we say when you trade something. When you buy something, if it goes up in value and you sell it, then you're going to have to pay a tax on it. You don't pay a tax just while it's going up. You can buy the ETFs, be automatically diversified, have lower fees, and have no surprise capital gains taxes, to where then you got to be digging into your savings to pay a tax. If you sold at a gain, you're going to have to pay a capital gains tax, but you're going to have that gain in there to pay the tax. So that's that's really what's going on with investing with ETFs. Now, I want to go into one other aspect of this and bring up something that this is where the money managers, I'll probably make them a bit nervous. Okay, so this is a 5-year chart. Now, you can see the NASDAQ did pretty good. The NASDAQ up 183% over 5 years. Here's what's interesting, ladies and gentlemen. There are leveraged versions of each of the 3 primary indexes. So let's take the NASDAQ out of here for a moment, and let's go and say, and you might want to have a pen handy, the leverage version of the S&P 500 is U as in Union, PRO. And this is 3 times, so it's supposed to go up more or less 3 times or go down 3 times more than what the S&P will do. So we're going to compare the S&P to its leveraged cousin, the UPRO. So here's the S&P, and compared to its leveraged cousin, which is up 319% instead of just under 100% for the S&P itself. Look on the other hand, with the leverage version, there is much more volatility. And this is where, if you're going to use leveraged ETFs to get a bigger gain, you have to be able to control your emotions, because there are times where it's going to go shooting up and there are times where it's going to fall like a rock. Let's go up to our comparison in the upper left here, and let's say, well, what did the NASDAQ do? And we're going to say the NASDAQ, let's say, is yellow. Boom. So by itself, the NASDAQ, ticker symbol QQQ, was up 183% over the previous 5-year period. The NASDAQ also has a 3 times leveraged ETF. And what is that? That is T as in Tom, QQQ. And you see it come up there, and we go boom, and let's make that green. Bang, look what happened. That is one big move, and look at the rate of returns you're going to be getting. Now, let me tell you, folks, that some of the professional money managers are going to say, this guy's crazy. You shouldn't be invested in these leveraged ETFs. I want you to know that they are a tool. It's like a hammer versus a screwdriver versus a pliers versus a saw. I want you to be educated that these exist. And when we had the market downturn, when we had that in March, and we see this sharp downturn, you know the market's not going to stay down forever. And that's the time, if you look at the leverage versions of these ETFs, of these indexes, you got a much bigger return, much bigger bang for the buck, because the blue line is the S&P 500, or let's say about February of last year of 2020. You see how we went down in March and we came back. The S&P was up 12, almost 13%. The NASDAQ, which is in gold, came up 43% since then. And the leveraged version of the NASDAQ, instead of coming up 43%, went up right at about 96%. So those are some very healthy returns. Now, what else can happen? Well, if we get a major downturn and you have those leveraged indexes, your money is going to go down 3 times faster. So this is where you have to either say, I'm going to hold on to them through thick and thin over time and go out 5 years, 10 years, or whatever. Or you kind of say, when the market's up high, I'm going to sell some of my shares to take some risk off the table. But the larger point is, if your money's growing at 13% versus your money in 2020 going up 96%, well, my goodness, folks, what that means is that your money in the S&P 500, that blue line, would take 7 years to grow to be as much as you could have made if you had just put it in the same period of time into the TQQ. That's the long and short of it. We have buying these ETFs. They are tools. You can buy just the S&P if you want and leave it at that. 500 different stocks. You're in every sector of the economy. You can put some into the S&P 500 and the NASDAQ and some in the Dow 30. Or, just to review, you can put some in the UDow. That's 3 times the Dow. 3 times the S&P 500 is U Pro, and 3 times the NASDAQ is TQQ, 3 Qs. What I would recommend you do is that you take your statement that you have from wherever it is you're investing, go to Yahoo Finance and put in the symbols up where it says comparison. You say comparison, you put in your symbol up there, and it's XYZ investment, whatever, and you put that in, and that'll That'll make a chart, and you can see how your money is growing relative to these alternatives that are there, and you ought to be aware of them. So, ladies and gentlemen, thanks for joining us as always. Give it a thumbs up if you would. If you haven't subscribed, please do. Please ring the bell and you'll be notified. And if you want to share the videos, you're more than welcome. For now, good investing. Thanks so much for joining us, and have a profitable week ahead.